What if I told you that right now, at this very moment, the US stock market is sitting at a dangerous level that has only been seen once before in the last 155 years? Hey there, I'm Smart Stock Sam, and today we're diving deep into something that every investor needs to understand: the warning signals flashing red across Wall Street that could trigger the biggest market correction of our generation. We're talking about a realignment so massive that it could reshape your portfolio, your retirement, and your financial future. Stick with me, because by the end of this video, you'll know exactly what's happening, why the experts are sounding the alarm, and most importantly, what you need to do right now to protect your hard-earned money. Let me paint you a picture. Imagine you're at an auction and everyone around you is bidding crazy amounts of money for something that's actually not worth that much. That's basically what's happening in the stock market right now. We're witnessing what the big players, the institutional investors, the hedge funds, the people who move billions of dollars, are calling the Great Valuation Realignment. Think of it like this. If you blow up a balloon too much, eventually it has to deflate, right? Well, the stock market has been inflating for years on something called liquidity momentum, which is just a fancy way of saying easy money. Central banks printed tons of cash, interest rates were super low, and everyone was buying stocks. But now, gravity is kicking in, and what goes up must come down. But here's the critical part that most people are missing. This isn't just about one bad week or a temporary dip that'll bounce back in a month. There's a specific signal that professionals use to measure whether the market is overvalued, and right now, that signal is screaming at us. It's called the CAPE ratio. Think of it as a thermometer for the stock market. When it reads too high, it means stocks are too expensive compared to what companies actually earn. Right now, that thermometer is reading 40.38. To put that in perspective, the normal healthy reading is around 17. We're at more than double that. And here's what makes this even scarier. We're facing not just one problem, but three massive problems all hitting at the same time. I call it the triple threat convergence. We've got phantom job growth that looks good on paper but is actually terrible underneath. We've got this massive AI spending bubble where companies are pouring money into artificial intelligence but not seeing real profits. And we've got geopolitical chaos with tariffs and trade wars making it harder and more expensive to do business globally. Now, if you were watching the news on February 11th, 2026, you saw something historic happen. The Dow Jones fell below 50,000 points, a psychological barrier that everyone thought would hold. Imagine you're standing on what you think is solid ground, and suddenly the floor beneath your feet just cracks and gives way. That's what happened. This wasn't just volatility, the normal up and down movements we see every day. This was a diagnostic signal, like when your car's check engine light comes on. It's telling us that the market is finally waking up to reality and realizing, hey, we might have gone a bit too far here. But wait, it gets more intense. Even after that big drop, the math is telling us we still might have a long way to fall. Want to know something that'll blow your mind? To get back to what experts consider fair value, where stock prices actually match what companies are worth, the S&P 500 would need to drop to somewhere between 3,600 and 3,800. Right now, we're way above that. We're officially in what I call code red territory. The market is 33% above where it should be historically. To give you context, we've only seen this kind of extreme overvaluation twice before in modern history. During the 2000 dot-com bubble, when everyone thought internet companies would make infinite money, and during the 2008 financial crisis, when the housing market collapsed. Both times, what happened next? Massive crashes that took years to recover from. So, what exactly is pulling the rug out from under us? Let me break down these three pillars that are crumbling right now. Imagine a three-legged stool. If any one leg breaks, the whole thing collapses. First, let's talk about the labor market, which is like the foundation of our entire economy. The January 2026 jobs report came out, and the headlines screamed, 130,000 new jobs added, economy is strong. But here's what they didn't tell you in those headlines. When they went back and looked at the 2025 numbers more carefully, they discovered they had overcounted by almost 1 million jobs. That's not a typo. Nearly 1 million positions that everyone thought existed just disappeared when they double-checked the math. It's like thinking you have $1,000 in your bank account, but when you actually look at your statement, you only have $10. We've been operating on what I call phantom growth. Growth that looked real but was actually just an illusion. The reality is we've been in what's called a hiring recession for months, meaning companies have quietly stopped hiring, but nobody was paying attention. Now let's talk about the second pillar, technology and AI. You've probably heard all the hype about artificial intelligence, right? Every company is talking about AI this, AI that, how it's going to revolutionize everything. And don't get me wrong, AI is cool and powerful. But here's the problem. Companies are projected to spend $600 billion, that's billion with a B, on AI infrastructure in 2026 alone. We're talking about massive data centers, powerful computer chips, energy to run all those servers. But here's the uncomfortable question nobody wants to ask. Where's the money coming back? The actual software profitability, the real returns from all this spending, is minimal, almost negligible. Imagine if you spent $600,000 building a fancy lemonade stand with the most expensive equipment, but you're only selling $100 worth of lemonade. That's basically what's happening. We're witnessing what I call the Great ROI decoupling. ROI stands for Return on Investment. The spending is astronomical, but the returns are nowhere to be found. The era of growth at any cost is over, and now investors are saying, show me the money. Where are the actual profits? The third pillar is all about policy, both trade policy and monetary policy. Think of the global economy like a well-oiled machine. For it to work smoothly, goods need to flow easily between countries, and money needs to be affordable to borrow. But right now, sand is being thrown into the gears. On the trade side, we're seeing something called Liberation Day tariffs, basically taxes on goods from about 100 different nations. There's also talk about potentially withdrawing from the USMCA, which is the trade agreement between the US, Mexico, and Canada. Every time you add tariffs, the cost of doing business goes up. Meanwhile, the Federal Reserve, which is like the central bank that controls interest rates, has kept rates at 3.5% to 3.75%. Now, you might think, Sam, that doesn't sound that high. But remember, for the last decade, rates were basically at zero. Going from 0 to 3.75% means borrowing money is now expensive. This is what we call the cost of capital, how much it costs companies to borrow money to grow their business. And all those rate cuts everyone was hoping for, they keep getting delayed and pushed further into the future. But here's where things get really scary, and this is something most people have never even heard about. There's a hidden systemic risk brewing overseas that could trigger what I call a global margin call. Let me explain this in simple terms. For years, big investors did something really clever, or so they thought. They would borrow money in Japanese yen when interest rates in Japan were super low, basically free money, and then they'd use that borrowed yen to buy expensive US stocks and assets. It's like taking out a zero-interest loan in one currency to invest in something that's growing in another currency. Free money, right? But here's the catch. Japanese interest rates just hit 25-year highs. Now all those investors who borrowed cheap yen suddenly have expensive yen to pay back. This forces them to sell their US stocks, not because they want to, but because they have to cover their loans. It's non-discretionary selling, meaning they have no choice. We could see trillions of dollars in forced selling just to cover these yen liabilities. Imagine everyone trying to rush out of a movie theater at the same time. That's what this could look like in the stock market. So, with all these forces colliding like a perfect storm, what does the recovery timeline actually look like? Here's where I need you to pay close attention because this could affect your financial decisions for the next several years. Everyone's been talking about the soft landing, this idea that the economy would slow down gently, maybe a small 10 to 15% correction, and then we'd bounce back by early 2027. It would be like a plane landing smoothly on the runway. Well, the probability of that soft landing has now dropped to just 30%. Instead, the institutional base case, meaning what the smart money is actually preparing for, is now a hard landing. This means a 25% to 35% market contraction with a recovery horizon of 2 to 3 years. That's not a quick bounce back. That's years of your portfolio being underwater. And here's the part that keeps me up at night. There's a 20% tail risk of what we call a full crash scenario. This would be a 40% to 50% wipeout that could take 5 to 7 years for a secular recovery. Think about that. If you're planning to retire in 5 years, this could completely change your timeline. So, what do we do about it? How do you protect yourself when the storm clouds are gathering? This is where we shift from diagnosis to treatment. Your new mandate, your new mission for your money, is capital preservation. Notice I didn't say making huge gains or beating the market. Right now, it's about not losing what you've worked so hard to earn. First critical move. If you're using margin, which means borrowing money to invest, you need to understand that margin is an accelerant of loss. When the market goes down 10%, your margin position might go down 20% or more. You need to deleverage immediately. Get rid of that borrowed money. Second, stop reactive selling. What does that mean? It means don't panic and sell everything when you see red numbers. Instead, follow a preset plan. Decide now, before emotions take over, what your strategy will be. And here's a key metric. We're not looking for aggressive buying opportunities until that CAPE ratio I mentioned earlier drops back below 20. Remember, it's at 40 right now. We need to see it cut in half before we start getting aggressive again. Now let's talk about where to actually put your money to survive this. The strategy is what I call flight to safety. We're moving into hard assets and essential services, the boring stuff that actually works when everything else is falling apart. Gold and silver are your primary hedges against currency erosion. When governments print money and currencies lose value, gold and silver historically hold their worth. Think of them as financial insurance. Then we want to look at companies that provide things people absolutely need, regardless of what's happening in the economy. Healthcare. People still need medicine and doctor visits during a recession. Utilities. You still need electricity and water, right? Consumer staples like Coca-Cola. People still buy toothpaste and soap and groceries even when times are tough. These companies provide steady cash flow when the rest of the market is on fire. But Sam, what about tech? What about AI? Should we just abandon it entirely? Not exactly, but you have to be surgical, super precise about what you choose. You want to avoid speculative software companies with unclear ROI, those companies burning through cash without clear profits. Instead, look at what I call the shovels of the industry. During the California gold rush, you know who made the real money? Not the gold miners, the people selling the shovels and pickaxes. In AI, the shovels are the hardware giants: NVIDIA, AMD, Micron. These are the companies making the chips and physical infrastructure that AI needs to run. The demand for compute power is non-discretionary, meaning it doesn't matter if the economy is good or bad, companies still need these chips to power their AI systems. To find the ultimate winners that will survive and thrive through this realignment, we need to look for one specific trait, what I call a fortress balance sheet. Let me break down what that means in simple terms. First, you want asset-light operations. This means companies that don't need massive factories or expensive physical infrastructure to operate. They can preserve their profit margins more easily. Second, low debt-to-equity ratio. Imagine two people. One has tons of credit card debt at high interest rates, the other has no debt. When interest rates go up to 3.5%, who's going to be fine? The person with no debt. Same with companies. And third, this is the most important: pricing power. This means the company can raise its prices without losing customers. If Coca-Cola raises its prices by 10%, people still buy Coke. If a random tech startup raises prices by 10%, customers might just leave. Companies with pricing power can maintain their revenues even when costs go up. Before I share my final verdict, I need to give you an important reminder. The information I've shared in this video is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Everyone's financial situation is unique, and what works for one person may not work for another. past performance of any investment or strategy does not guarantee future results. The stock market involves risk, including the potential loss of principal. Before making any investment decisions, you should consult with a qualified financial advisor who understands your personal circumstances, risk tolerance, and financial goals. I am not your financial advisor, and nothing in this video should be construed as a recommendation to buy or sell any specific security or investment. So, what's the final verdict? What should you do with your portfolio right now? Here's the bottom line, and I want you to really hear this. We are in a liquidity-driven drawdown. All that easy money that pushed stocks higher and higher is now being pulled back. Volatility is now a feature, not a bug, meaning wild price swings are going to be normal, not unusual, for the foreseeable future. The soft landing scenario that everyone was hoping for is likely dead. Your move right now, today, is to execute deleveraging, get rid of borrowed money in your investment accounts, and pivot to what I call productive assets. These are the assets that actually generate real cash flow, real earnings, real value. In a market defined by the unwinding of excess, where all the overvaluation is being squeezed out, the durability of a fortress balance sheet is your only reliable defense. If you want to see which specific sectors and stocks are leading my Fortress strategy list, make sure you're subscribed to Smart Stock Sam and hit that notification bell so you don't miss the follow-up videos where I'll break down exact positions and defensive plays. The Great Realignment is here, and the investors who prepare now will be the ones who come out on the other side not just surviving, but thriving. Stay smart, stay safe, and I'll see you in the next one.